and Richard Marks there. Morning, all. I appreciate you being here. I'm Morning Dave. We're at 8:39 here. It's 21 now before 9.
Advisory services offered through Second Half Financial Partners, LLC, an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.
And that's always a good idea. Let's check in and find out what's happening on Wall Street today through the good auspices of our friend Philip Statler from Statler Financial Services in downtown Sebring. Philip, good morning. How are you today?
Hey, good morning, David. Doing well today. It is, but it's been hot as blazes. I don't know. Can you turn on some air conditioner somewhere? I mean, I'm just, I don't want to go outside anymore.
I was going to razz you because you always say you're doing well, and I was going to say, when are you going to tell me I'm hotter than heck and I don't like this a bit? And it's going to be pretty well dry until Friday as well, with Bertha hanging out there in the Gulf over Louisiana. It's going to be sucking the moisture off the peninsula until our next tropical wave arrives. So, yeah, it's going to be hot. It's going to be steamy. Heat index is up around 105 or so. It's a darn good time to sit inside in the air conditioning and work over your retirement portfolio. Speaking of which, if you got it in stocks, it wasn't a great day yesterday. One of my tip sheets was saying we're mostly just marking time, waiting for the big tech reports. And I'm sorry, I don't call a 307-point drop on the Dow just marking time. It lost 0.59% yesterday. Standard & Poor's was down by 14.5. NASDAQ down by 12, which, okay, fine, I'll call that marking time. And the Russell lost 0.2%, down 0.67%. We're just all a bundle of nerves over the situation with Iran, and I still haven't heard a follow-up on that report that we had early yesterday morning about the Ayatollah having skipped the country. I'm wondering if that was just a rumor that died as soon as it came out.
Oh, interesting. I didn't see that headline. That is quite interesting. I did see, though, that, now there's some rumblings about not just the Strait of Hormuz, but also the Red Sea being an issue.
That had the oil.
Yeah.
That had the oil futures topping up over 85 for a little while. They're almost there now, but yeah, the idea now Iran wants to blockade the Saudi oil ports on the Red Sea.
Yeah,
Thanks,
we just can't buy a break here lately, can we?
It's starting to get that way in the process, and the problem is what it's going to end up doing is putting us in a bigger military position than even President Trump had in mind. Bottom line, negative day, and you add to the fact that we're nervous about Iran, we're still getting rid of chip stocks and tech stocks. One of my analysts is saying it's time to dump the Magnificent Seven. And now I got a little headline here that says even the big hedge funds are starting to dump tech stocks and rotate out of them and head back toward the safer traditional industries. We're just falling out of love with tech for a little while, aren't we?
Yeah, it does. I mean, let's face it, Dave, they've had a heck of a run, right? And so at some point, I talk about this with my clients. There's this, you got to weigh this out, right? Pay the tax on the gains or risk, the downturn in the market. At some point, you got to be willing to pull the trigger and rebalance and decide to get, to switch, kind of what sectors you need to be in and take those gains and pay the tax on them if you're in a non-qualified account. Obviously, IRAs don't have to worry about that, but still, it's a balancing act between the two as high as we've gotten.
And that balancing act really varies heavily depending upon, number one, your faith in the companies, and number two, your age. This might be something that a 40-year-old could just ride out, but if you're in your late 50s, early 60s, and you're heavily invested in tech, brother, you might want to think about a rebalance act. Wouldn't you agree?
Yeah, absolutely. You definitely want to at least consider it. Run
Absolutely.
the numbers.
Other tidbits out this morning. A judge put a hold on the Paramount-Warner merger, saying that bunch of states have said they're tying up a vital industry. I didn't know going to the movies was a vital industry, but they're worried about monopolistic tendencies. So a judge now has put a hold on that big corporate merger. I thought once it got by the Department of Justice, we'd pretty much leave them alone. Evidently not, right?
Guess not. Somebody must not be happy with the merger. So, file suit. So, hey, another headline. Get this one. Jamie Dimon says markets are underestimating risk and he wouldn't buy stocks or treasuries at the current prices.
When you shared that with me, my first reaction was after his bank set a new record revenue off of trading revenue, he turns around after the report comes out and say, "Okay, guys, stop everything." Every once in a while, somebody that's that dependent upon trading activity goes. I kind of wonder whether he's seeing better commissions coming out of sell orders right now than it is buy orders, and just saying, "Okay, that's how I'm going to pump myself up for this quarter."
Tell people to get out, right?
Suspicious much, am I? Let's see other tidbits. Google is jumping on report the company is developing a new AI chip, but at the same time, Alphabet says they're dumping a ton more money into data centers and data servers. They're going to love developing a new chip, but then we've kind of seen that the market does not like a whole bunch of CapEx expenditures. Sounds like they're actually hedging their bets on their buyers, doesn't it?
It does. It does. And the chips, let's face it, the chip industry is getting beat up, but at some point, everybody's coming out with a new chip and it's supposed to be better, faster. And so as long as they continue their R&D, we who knows where they'll go with the chip industry.
Absolutely. And they are starting to get used more frequently. Another note that I had this morning, big drug company, Bristol Myers, they've bought NVIDIA's latest AI system for drug research. I'm not 100% sure I feel good about the next wonder drug having been tested on artificial intelligence instead of living beings, but that's an interesting way to do it. I found it kind of interesting to see it happen. As far as the chip manufacturing, the chip manufacturers announce a new chip, and their stock goes through the roof. Then the other companies say, "Okay, we're buying it," and everybody penalizes them for CapEx expenditures and trades their stocks down. Somewhere down the line, maybe Jamie Dimon has a point.
Hey, I see that Trump imposed a 50% tariff on certain Canadian goods.
So I hear. I guess I have trouble getting excited about that just on the grounds that they never stick anyway, do they?
Yeah, they don't seem to be sticking here lately anyway.
Not very danged often. We do have some stocks to report on this morning that are trading and reporting their quarterly earnings, just in case anybody hasn't put two and two together and figured out there's absolutely nothing going on this week as far as government data dump. How did General Motors do last quarter?
Hey, they had a good quarter, Dave. They beat earnings by about 37 cents a share, came in at $3.57. Earnings above expectations by about $1 billion. And so they were trading up earlier this morning. Let's see. Yep, still up, not by much, about 0.2% right now.
Good Lord, that's good.
So the other side of the coin, however, we have pizzas. Domino's Pizza didn't do quite so well. They missed earnings by about 10 cents a share, came in at 407 versus 417. Revenues just a tad above expectations. And so I was thinking, well, they were down earlier this morning, but they have flopped to the other side and are up actually 2.1%. I guess on the dip, people decided to buy.
The food trade is such a challenge because your ingredient prices are going up. The consumer is not particularly flexible on price increase. And Domino's doesn't have stuff like coffee that'll end up being a high-margin item that can keep their mainline prices down. They probably revenue up, profits off. Okay, that almost makes sense, doesn't it?
It does, because you're right. They have a hard time increasing prices to cover the increased cost. And they're quote kind of a low cost provider anyway in the pizza industry.
Absolutely. And like I said, they don't have the high margin stuff. A sit down restaurant can get away with charging $2.50 for a cup of coffee that costs you 3 cents to make, and that controls the price of the entrees because you're making the money up on the extra stuff that's high margin. Domino's, get a pizza in a box. I'm sorry, there's nothing extra there for me to build in the profit margin on. That's a challenging line of work to be in right now.
Yep, it really is. The last one I have for you today, Dave, is 3M. You know, the makers of the Post-it note and Scotch tape. They had a good quarter. They beat on both earnings and revenue. And the good thing is always this: they raised their full year guidance.
Cool.
So they are trading up 6.5%, almost 6.5% this morning.
I'm glad to hear that. I've got some family members that spent a lot of their careers at 3M, so I'm always happy to see them doing well. We talk about something not immediate, but always something worth planning every day these days. Talking about Tax Time Tuesday. Got some advice for us this morning?
I do. And this is going to talk about kind of that gap between when you retire and when you start drawing Social Security and pensions and that kind of stuff. You've got this gap where you quit working and now you're probably in the lowest tax bracket you're ever going to be in. And if we look at kind of the sample of Bob and Linda, they're 64, they just retired. And if you look at them, neither one of them started their pensions or Social Security yet. They're going to live off their savings for a little while. They got a large IRA. And so at that point, they're going to be in their lowest tax bracket ever. So it won't last for long because at some point they'll start taking Social Security, they'll have their pension, and they'll have to start taking their RMD off their IRA. So that you've got this little block of time where you've got an opportunity to start converting traditional IRA to Roth IRA. And in this case, they were able to take about $60,000 a year from their traditional IRA, convert it to Roth, and still stay in their low tax bracket. Now, they were in the high end of the low tax bracket, but still they were paying at that 12% instead of having to breach over to that 22, which is where they will be when their pension and Social Security kick in. So it's a time to start looking at how much can I convert every year to a Roth? Because the advantage of the Roth is it grows tax-free. You don't ever have to take money out of it if you don't want to. And so it's just a great place to be when it comes to retirement planning. So look, if you're not sure, if you have an opportunity to do that, it's a good time to kind of analyze everything and see if it makes sense for you to start doing some Roth conversions, and so that you can get yourself in a lower tax bracket down in the future.
Kind of emphasizes the benefit of having a 5 or a 10-year plan instead of just a 1-year plan in your mind too, doesn't it?
Oh, absolutely. Oh, absolutely. It does. You got to have a plan for those type of things.
Absolutely. Resetting the table for the morning, it was generally a negative day yesterday on Wall Street, except for gold. It was up nicely. 45 minutes before we go this morning, how are we looking so far today?
Hey, we've got some green ink this morning, Dave. The Dow is trying to bounce back a little bit, is up about, a little over 0.2%. S&P 500 is up 0.4%. That's about $30. And the NASDAQ 100 is up a little over 1.25%. The Russell 2000 is up 0.4. So not a bad start to the day. On the other side, we're seeing a huge jump in silver, up 3.9%. Still under 60 though, Dave, at $59.29. Gold still on a tear, up 1.2. Crude oil, unfortunately, still up 1.8% this morning, $84 even for a barrel. That's man, I need that thing to start falling.
I do too. I'm due to gas up. Looking overseas, the Asian Rim markets generally up, and surprisingly, I'm not sure why. Mainland Chinese markets were up well over 2% on average at the end of the day. And over in Europe, they're about the same thing, a little bit more optimistic. Not as excited as the Asians are, but average European index is up by about 0.25%, halfway through their trading day over there. So little optimism reigning this morning. Philip, if I wanted to get together and figure out how to turn this into a more productive retirement, how do I find you?
David, give us a call at 863-382-0037. We'd love to spend 30 minutes with them to see where they are, where they're trying to get to, and if we can help them get there. And then catch the Statler Financial Radio Show this weekend, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30 a.m. and 95.3 FM.
And you and me again tomorrow morning to fill them in as to what's going on down to the minute here. Have a great day, and I'll see you then, sir.
All right, buddy. Take care.
Take care. It's 105.7 Light FM and Statler Financial Services. Philip Statler.
Hey, folks. Thanks for joining us today. Hope your day's going well. I look forward to speaking to you again tomorrow. Take care. Bye now.